The Clarity Act isn't dead. But the biggest problem facing crypto regulation in the United States may no longer be the delay. It's what happens next. The Senate has now pushed the key procedural step into September. And when lawmakers return, the bill will face a much tougher political environment. For crypto investors, companies, exchanges, and developers, this could be one of the most important moments of 2026. Welcome to BlockAlpha. We decode crypto. We don't chase hype. Today, we're breaking down what happened to the Clarity Act, why September 15th matters, what could prevent the bill from moving forward, and what the delay could mean for the future of crypto regulation in the United States. Let's start with what actually happened. The Digital Asset Market Clarity Act, commonly known as the Clarity Act, is designed to create a federal framework for digital assets in the United States. One of its biggest goals is to provide clearer rules around which digital assets fall under securities regulation and which fall under commodities regulation. It also aims to clarify the responsibilities of the Securities and Exchange Commission and the Commodity Futures Trading Commission. For years, the crypto industry has complained that the United States has relied too heavily on enforcement and not enough on clear rules. The Clarity Act is supposed to change that. But the Senate did not complete the expected vote before leaving Washington for its August recess. Instead, Senate Majority Leader John Thune filed cloture on the motion to proceed to the bill. And according to the Senate's own schedule, that cloture motion is now set to ripen on September 15th. That distinction is extremely important. September 15th is not simply a vote that automatically makes the Clarity Act law. It is a procedural step. Senators first need to agree to move forward with consideration of the legislation. And that requires 60 votes. That's where the problem begins. Because the Senate does not have unlimited time. Lawmakers return from the August recess in mid-September. The November elections are approaching. And there are only a limited number of legislative days remaining in the year. That means the window for getting a major crypto market structure bill through the Senate is getting smaller. And passing the bill through the Senate would not be the end of the process. The House and Senate would still need to resolve differences in legislation. And the final bill would then need to reach the President. So when someone says, the Clarity Act is going to pass on September 15th, that's not what the current process means. September 15th is a critical checkpoint. Not the finish line. And this distinction matters because crypto markets are extremely sensitive to expectations. When investors believe regulatory clarity is coming, companies can make longer-term plans. Institutional investors may become more comfortable entering the market. Crypto exchanges can plan products around clearer rules. Developers can better understand the legal environment they're operating in. But when legislation gets delayed, uncertainty remains. And uncertainty has a cost. Imagine you're building a billion-dollar financial company. You need to know which regulator has jurisdiction. You need to know whether a token could be treated as a security. You need to know what rules apply to trading platforms. You need to know what happens to decentralized protocols. And you need to know whether those rules could change again next year. That's very different from building in an environment with a clear regulatory framework. This is one reason the Clarity Act matters far beyond Bitcoin. It could affect exchanges. It could affect token issuers. It could affect decentralized finance. It could affect stablecoin businesses. And it could affect the institutions that want to build financial products around blockchain technology. But here's where things get even more interesting. The United States is not waiting for Congress to solve every crypto regulatory question. The SEC and CFTC have already been working on regulatory interpretations and frameworks. Earlier this year, the SEC and CFTC issued a joint interpretation addressing how federal securities laws apply to different categories of crypto assets and transactions. The SEC's framework distinguishes between categories such as digital commodities, digital collectibles, digital tools, stable coins, and digital securities. That means something important is happening. Even without a final Clarity Act, the regulatory environment is already changing. And that creates a very interesting situation. Congress is trying to create legislation. Regulators are developing their own frameworks. And the crypto industry is waiting for both to line up. Then there is another complication. On August 13th, the SEC cancelled a scheduled meeting that was expected to address crypto-related regulatory proposals. The agency said the cancellation was due to an unforeseen scheduling issue. No new date had been confirmed at the time of reporting. So now crypto is watching two separate developments. Congress has delayed its major market structure legislation. And the SEC has delayed a regulatory step of its own. That doesn't mean the United States has stopped working on crypto regulation. Quite the opposite. It means the regulatory transition is happening through multiple channels at the same time. And that's why September could become extremely important. But here's the question investors should really be asking. What happens if the Clarity Act fails? This is where the conversation becomes much more interesting. Because crypto existed before the Clarity Act. Bitcoin existed. Ethereum existed. Coinbase existed. DeFi existed. Stablecoins existed. The industry survived without a comprehensive market structure law. So failure would not mean crypto disappears. But it could mean that the United States continues operating without the broad legislative framework the industry has been asking for. And that could have several consequences. First, companies may continue to face regulatory uncertainty. Second, some businesses could choose jurisdictions where the rules are clearer. Third, institutional investors may continue demanding stronger legal protections before committing larger amounts of capital. And fourth, Congress could eventually have to start the legislative process again under different political conditions. That last point may be the most important. Because elections change political priorities. The Senate's composition can change. The House can change. Committee leadership can change. And suddenly a bill that looks close to passage today can become much harder to pass. That's why the 2026 timeline matters. The longer the process takes, the more political variables enter the equation. But there is also a bullish interpretation. The fact that the Senate has already initiated the procedural process means the Clarity Act is not simply sitting on a shelf. There is still a path forward. The Senate has a date. The bill has already moved through important stages. And the crypto industry continues to push for market structure legislation. So the story is not simply, Clarity Act failed. That would be misleading. The more accurate story is this: the Clarity Act has entered a much more difficult phase. September 15th is the next major checkpoint. And the outcome could determine whether the United States moves closer to a comprehensive crypto market structure framework or enters another period of legislative uncertainty. Now let's talk about what this means for Bitcoin. Bitcoin itself does not depend on the Clarity Act to exist. The network will continue operating regardless of what Congress does. But regulation can influence the environment around Bitcoin. It can affect exchanges. It can affect institutional products. It can affect custody. It can affect financial institutions. And it can affect how easily capital moves between traditional finance and digital assets. The same applies to Ethereum and other major crypto networks. Regulatory clarity doesn't automatically make an asset valuable. But regulatory uncertainty can make it harder for companies to build products around that asset. And that's why institutional investors are watching Washington so closely. The biggest story isn't simply whether Bitcoin goes up or down because of one Senate vote. The biggest story is whether the United States creates a regulatory environment where traditional finance and blockchain infrastructure can coexist at scale. And that brings us back to BlockAlpha's core thesis. Crypto isn't just about coins anymore. It's becoming a battle over financial infrastructure. Stable coins. Tokenized treasuries. Real-world assets. Digital securities. Institutional custody. On-chain settlement. All of these areas require rules. And those rules will determine which companies can build, which products can launch, and which investors can participate. So what should crypto investors watch next? Number 1. Watch September 15th. That is the next major procedural checkpoint for the Clarity Act. Number 2. Watch the negotiations around the bill. The final language matters. A bill can change significantly before it reaches a final vote. Number 3. Watch the SEC and CFTC. Regulatory action can continue even while Congress is debating legislation. And number 4. Watch institutional adoption. If banks, asset managers, exchanges and financial infrastructure companies continue building despite the legislative delay, that tells us something important. The industry is preparing for a future where digital assets are part of mainstream finance. The Clarity Act may accelerate that transition. But it isn't the only force driving it. So here's the bottom line. The Clarity Act is not dead. But September 15th is not a guaranteed victory. It is a test. A test of whether lawmakers can get enough support to move the legislation forward. And because the calendar is getting tighter, the stakes are getting higher. If the bill advances, crypto could move closer to a clearer federal market structure framework. If it stalls again, the United States could remain in a more fragmented regulatory environment for longer. And that uncertainty could influence where companies build, where capital flows, and how quickly institutional crypto adoption develops. For investors, this is not a reason to panic. And it's certainly not a reason to blindly buy a token because someone says the Clarity Act will make it explode. The smarter approach is to understand the infrastructure. Understand the regulation. Understand what the legislation actually does. And watch what institutions are doing with their capital. Because in crypto, headlines can change in a few hours. But regulatory infrastructure can shape an entire decade. September 15th is getting closer. And the next few weeks could tell us a lot about the future of crypto in America. If you want us to break down exactly what the Clarity Act could mean for Bitcoin, Ethereum, XRP, Solana, stablecoins and DeFi, comment Clarity below. And subscribe to BlockAlpha. We decode crypto. We don't chase hype. I'll see you in the next video.